Before we dive in, please remember that the information provided in this video is for educational purposes only and should not be considered as financial advice. Trading and investing involve substantial risk, and you should always conduct your own research and consult with a licensed financial advisor before making any investment decisions. The performance of past markets is not an indicator of future results. Alright, let's get into it. Imagine a guy named Mark. Mark works a solid 9 to 5, he saves a little bit from each paycheck, and he's finally decided it's time to make his money work for him. He opens his laptop, types "how to start investing" into the search bar, and falls headfirst into a digital rabbit hole. On one screen, he sees a Wall Street analyst in a crisp suit talking about the long-term power of the S&P 500, about owning a piece of American innovation, companies like Apple and Amazon. He's talking about patience, dividends, and building generational wealth. It sounds solid, sounds safe, but then he clicks another link. Suddenly, he's watching a high-energy trader in a slick home office, surrounded by 6 monitors flashing with red and green charts. This guy isn't talking about decades, he's talking about minutes. He's not talking about owning companies, he's talking about currency pairs, the euro versus the US dollar, the British pound versus the Japanese yen. He's throwing around terms like pips, leverage, and 24-hour market. It sounds exciting, sounds fast. Mark leans back in his chair, completely overwhelmed. One world promises slow, steady growth by betting on the companies that define our daily lives. The other offers a lightning-fast, global arena that never sleeps. Both claim to be the path to financial freedom, and the internet is screaming both answers at him at the same time. Does this sound familiar? This exact confusion is why millions of aspiring investors and traders in the United States give up before they even start. They're paralyzed by the choice between two financial titans, the US stock market and the foreign exchange or Forex market. Now let me hit you with a number that might just blow your mind. The New York Stock Exchange, the symbol of American capitalism, trades about $22 billion on an average day. That's a huge number. But the Forex market? It trades over $7.5 trillion every single day. That's more than 300 times larger. It is, without a doubt, the largest and most liquid financial market on the planet. So when you see that number, the question becomes even more intense. Am I in the right place? Am I missing out on a bigger opportunity? This is the core problem we are going to solve for you in this video. We are going to cut through all the noise, all the hype, and all the confusing jargon. We're going to put these two giants in the ring head to head, and give you a crystal clear, unbiased breakdown so you can figure out which one, if either, is the right choice for your personality, your financial goals, and your risk tolerance. We're going to explore what these markets actually are, how they fundamentally work, the unvarnished pros and cons of each, and the type of mindset that tends to succeed in each arena. By the end of this, you won't be marked, confused, and overwhelmed. You'll have a framework. You'll have clarity. You'll be equipped to make an informed decision. So let's start by properly introducing our two contenders. In one corner, we have what I like to call the hometown hero, the US stock market. This is the market most Americans are familiar with. It's the story of Wall Street, of ringing the opening bell, of investing in the brands you know, use, and love. When you buy a stock, you are doing something profound. You are buying a small fractional piece of ownership in a publicly traded company. Think about that. You buy one share of Starbucks and you are, in a very real sense, a part owner of thousands of coffee shops around the globe. You own a tiny fraction of their espresso machines, their real estate, their brand. If that company does well, innovates, and grows its profits, the value of your piece of ownership, your stock, has the potential to increase. If they pay out a portion of their profits to shareholders, you get a small check called a dividend. This is the classic American dream of investing. It's rooted in capitalism and the belief in long-term growth and innovation. You're not just trading a ticker symbol on a screen. You're investing in the future of Microsoft, the logistics of Amazon, the electric vehicle revolution of Tesla. You are betting on the success of a business, its management, its products, and its place in the economy. This market operates on a set schedule. The main exchanges, the NYSE and the Nasdaq, open at 9:30 a.m. Eastern Time and close at 4 p.m. There's an opening bell and a closing bell. It has structure. It has a rhythm. When the market closes, for the most part, the game pauses until the next morning. The primary appeal here is the potential for long-term capital appreciation. You buy a piece of a great company, you hold it for years or even decades, and you allow the power of compound growth to work its magic. It's a marathon, not a sprint. It's a strategy favored by legendary investors like Warren Buffett, who famously said his favorite holding period is forever. It's about fundamental analysis, digging into a company's balance sheet, its income statement, its leadership, and its competitive advantage to determine if it's a worthwhile long-term investment. People choose stocks because they want to build wealth steadily over time, participate in the growth of the US and global economy, and own a tangible piece of the businesses that shape our world. But that's only half the story. It's the familiar, well-trodden path. It's powerful, it has a long history of creating wealth for patient individuals, but it's not the only game in town. What if you're not wired for the slow and steady marathon? What if you're more interested in short-term movements, global economics, and a pace that moves at the speed of light? What if you're less interested in owning a company for 10 years and more interested in the economic relationship between two countries over the next 10 hours? That's when the other contender, the global gladiator, steps into the ring. And understanding this beast is the first step to knowing if you should ever dare to face it. This gladiator is the foreign exchange market, better known as Forex or FX. And unlike a stock, you're not buying a piece of a company. You're not betting on the next iPhone or a breakthrough drug. In Forex, you are participating in the largest, most liquid financial market on the planet, where the product being traded is money itself. Think about it this way. If you've ever traveled from the US to Europe, you've participated in the Forex market. You went to a currency exchange, handed over your US dollars, and received euros in return. The price you paid, that exchange rate, was determined by the massive swirling forces of the global Forex market. Forex trading is simply the act of doing this on a grand scale, speculating that the value of one currency will rise or fall against another. You're not hoping a company succeeds, you're analyzing the economic health of an entire country, or two countries, relative to each other. To call this market big is a profound understatement. It's a titan. The New York Stock Exchange, the largest stock market in the world, might see around $200 billion in value traded on a busy day. That sounds like an astronomical number, and it is. But the Forex market? It trades over $7 trillion every single day. That's not a typo. Trillion with a T. It dwarfs every other market combined. It's a 24-hour-day, 5-day-a-week behemoth that never truly sleeps, passed like a baton from financial centers in Sydney, to Tokyo, to London, and then to New York in a continuous cycle. So how does one actually trade in this colossal arena? It all comes down to something called a currency pair. You're always trading one currency against another. The most traded pair in the world, for instance, is the euro to US dollar, the euro versus the US dollar. When you see a price for this pair, say 1.08, it's asking a simple question. How many of the second currency, US dollars, does it take to buy one of the first currency, euros? In this case, it would take $1.08 to buy a single euro. Your goal as a trader is to anticipate which direction this number will go. If you believe the European economy is strengthening and the euro will become more valuable relative to the dollar, you would buy the euro to US dollar pair. This is called going long. You're buying euros with dollars, hoping to sell them back later at a higher price for a potential profit. Conversely, if you believe the US economy is outperforming and the dollar will strengthen, you would sell the euro to US dollar pair. This is called going short. You're effectively betting that the euro will weaken, allowing you to buy it back cheaper later. This ability to potentially profit from both rising and falling markets is a fundamental feature of Forex. Because these exchange rates often move in very small increments, the changes are measured in what's called a pip, which stands for percentage in point. It's typically the fourth decimal place in a currency quote. For example, if the euro to US dollar moves from 1.0800 to 1.0801, that's a 1 pip move. Now, a 1 pip move is worth a tiny fraction of a cent. You might be thinking, how could anyone possibly make meaningful returns from such small movements? And this question leads us to the single most important, most powerful, and most hazardous concept in the world of Forex: leverage. Leverage is the defining characteristic of the Forex market, and it's what attracts and simultaneously demolishes so many aspiring traders. In the stock market, if you have $1,000, you can typically buy $1,000 worth of stock. In Forex, brokers offer you leverage, which is essentially a short-term loan. They might offer you 50-to-1 leverage. This means for every $1 you put up from your own capital, you can control $50 in the market. So your $1,000 account can now command a $50,000 position. Suddenly, that tiny 1 pip move isn't so tiny anymore. Leverage acts as an amplifier. It magnifies the scale of your trades, which in turn magnifies both your potential gains and your potential losses. A small percentage move in the market could translate into a very large percentage return on your initial capital. This is the siren song of Forex. It's the allure of controlling vast sums of money with a relatively small stake. But this amplification is a brutal, unforgiving, double-edged sword. If the trade moves against you, your losses are also magnified by that same 50-to-1 ratio. A small adverse move in the market can result in a catastrophic loss, potentially wiping out your entire account in a matter of minutes or even seconds. This is not a theoretical risk. It is a common reality for those who don't fully respect the power of leverage. It is the single biggest reason why the Forex market has a reputation for being so risky. It's a superpower that, if mishandled, becomes kryptonite. Understanding this mechanism isn't just important. It's a non-negotiable prerequisite for survival. This high-speed, high-stakes environment is driven by factors far broader than what moves a single company's stock. You're not reading quarterly earnings reports from a CEO. You're watching the macroeconomic heartbeat of entire nations. The primary driver is interest rates. When a country's central bank, like the US Federal Reserve, raises interest rates, it can make holding that country's currency more attractive to foreign investors seeking higher returns, potentially driving up its value. Beyond that, you have a constant stream of major economic announcements. Inflation data, gross domestic product, GDP, reports, employment figures, retail sales numbers. Each one of these releases can send shockwaves through the market, causing currencies to surge or plummet in an instant. Then you layer on top of that the unpredictable nature of geopolitics. An election in one country, a trade dispute between two economic superpowers, or an unexpected conflict can override all the economic data and trigger massive volatility. You're not just an analyst, you're part economist, part political scientist, watching a global chess match play out in real time. So this is the global gladiator, a decentralized $7 trillion a day market that never sleeps. It offers unparalleled flexibility with its 24-hour nature and incredible potential amplification through leverage. But it demands a deep understanding of global economics and an ironclad respect for risk, because that same leverage can inflict devastating losses with breathtaking speed. It's a world of pips, pairs, and macroeconomic pressure, a pure play on the shifting economic tides between nations. So we have this colossal, fast-paced global arena, but how does it actually stack up against the tried-and-true engine of American wealth creation? What happens when you put the day-to-day performance of a company like Apple or Amazon under the microscope? That's where the story gets really interesting. We move from the battle of nations to the battle of corporations, and the rules of engagement change completely. When you trade stocks, you're not just trading a ticker symbol on a screen. You're placing a bet on a story of innovation, of competition, of human ambition and failure. You're buying a tiny fractional slice of a real-world enterprise. Think about it. Owning a share of a company like Microsoft isn't an abstract concept. It's owning a microscopic piece of every Windows license sold, every Azure cloud server humming away, every Xbox controller in the hands of a teenager. You are, in a very real sense, a part owner of the business. This is the fundamental bedrock difference between stocks and Forex. You're not trading the relative value of two abstract economic systems. You're investing in a specific team, a specific product, a specific vision for the future. So what drives this corporate roller coaster? What makes a stock like Nvidia soar to unimaginable heights while another, once great company, fades into obscurity? It boils down to a few critical battlegrounds. First, and most famously, are the earnings reports. 4 times a year, every publicly traded company in the US has to open its books and show the world its report card. They stand before Wall Street and declare, "Here's how much money we made, here's how much we spent, and here's what we think will happen next." This is the Super Bowl for investors. The days leading up to an earnings call are filled with tension, speculation, and analysis. Did they beat the analysts' expectations? Did they miss? By how much? A single sentence in a press release or a specific tone of voice from the CEO on the subsequent conference call can send a stock price rocketing up 20% or plummeting 30% in a matter of minutes. It is pure, unadulterated corporate drama, and it's a primary source of the volatility that stock traders live and breathe. Then you have the engine of progress itself, innovation. Nothing moves a stock quite like a breakthrough product. Think back to the launch of the first iPhone. It wasn't just a new phone. It was a paradigm shift that reshaped an entire industry, and set Apple on a course to becoming one of the most valuable companies in human history. Traders and investors are constantly on the hunt for the next big thing. Will it be a new artificial intelligence model? A life-saving drug from a small biotech firm? A revolutionary electric vehicle? A single patent approval or a successful clinical trial can be the spark that lights a fire under a stock, creating life-changing potential outcomes for those who saw the vision early. Of course, these companies don't operate in a vacuum. They are locked in a relentless war for market share. This is the battle of titans. Coca-Cola versus Pepsi, Ford versus General Motors, Netflix versus the entire streaming universe. One company's blockbuster success is often another's crushing defeat. If a new video game console flies off the shelves, its competitor's stock might take a hit. If a fast food chain introduces a wildly popular new item, you might see the stocks of its rivals dip. The stock market is the ultimate scoreboard for these corporate conflicts, and every news headline about market share, every new ad campaign, is another skirmish in the ongoing war. And hovering above it all is the human element, the vision, and sometimes the ego of a company's leadership. The CEO effect is a powerful, unquantifiable force. A visionary leader like a Steve Jobs or a Jensen Huang can inspire so much confidence that investors will follow them almost anywhere, sending their company's valuation into the stratosphere based on the belief in their genius alone. Conversely, a scandal, a misspoken word, or the departure of a key executive can shatter that confidence in an instant. In today's hyper-connected world, a single tweet from a high-profile CEO can add or subtract billions of dollars from a company's market capitalization before you've even had your morning coffee. This creates a flavor of volatility that is distinctly different from the Forex market. In Forex, you're usually dealing with gradual macro-driven movements, magnified by leverage. A big move might be 1 or 2% in a single day. In the stock world, individual companies can experience cataclysmic, news-driven events. Imagine a pharmaceutical company whose flagship drug fails its final stage trial. The stock could open the next morning down 80%. There is no leverage needed to feel that kind of impact. On the flip side, a small tech company that gets a buyout offer from a giant like Google could see its stock price double overnight. This is event-driven volatility, and it's sharp, sudden, and can be incredibly unforgiving, but it also presents unique opportunities. This leads to two fundamentally different mindsets you can adopt when approaching stocks. There's the path of the investor, famously championed by figures like Warren Buffett. The investor is buying the business, not the stock. They do deep dive research into the company's financials, its management team, its competitive advantages. They're in it for the long haul, believing that over years or even decades, the quality of the business will shine through and the stock price will follow. They are owners, patiently waiting for their slice of the company to grow in value. Then there's the path of the trader. The trader is less concerned with the company's 10-year plan and more concerned with its 10-day or 10-minute price action. They study charts, look for patterns, and play the volatility around events like earnings reports or product launches. For the trader, the stock is a vehicle for capitalizing on short-term price swings. They aren't married to the company's story. They are simply dancing with its stock price. Both approaches have their own sets of challenges and potential rewards, but they spring from the same core concept, that you are dealing with the fate of a single, identifiable business. So we have the grand chess match of global economies with Forex, and the intense individual gladiator battles of the stock market. But knowing the story behind the price is only half the battle. How do you actually play the game? What are the practical day-to-day differences when you sit down at your screen? We're talking about trading hours, leverage, and the very structure of the markets themselves. And one of these markets never ever sleeps. Let's start with the most dramatic difference, the one that fundamentally changes how you live your life as a trader: the clock. The US stock market operates on a schedule that feels familiar. It's like a traditional workday. The opening bell at the New York Stock Exchange rings at 9:30 a.m. Eastern Time, and the closing bell rings at 4 p.m. That's it. For 6.5 hours, the game is on. After that, the main market is closed. Sure, there's some after-hours and pre-market trading, but the liquidity, the volume, the real action, it's concentrated in that specific window. This structure has its pros and cons. On one hand, it's defined. You know when you need to be at your screen. It forces a certain discipline. When the market closes, you can step away, decompress, analyze your day, and prepare for the next. It creates a boundary between your trading life and your personal life. But what if you have a 9-to-5 job on the East Coast? Your entire workday perfectly overlaps with the market's open hours. It can be incredibly difficult, if not impossible, to actively trade stocks while also trying to excel at your career. For someone on the West Coast, it's a bit easier. The market opens at 6:30 a.m. their time. But for many, the stock market schedule dictates their life. You adapt to the market's hours. Now let's look at Forex. The Forex market doesn't have a bell. It has a heartbeat that pulses across the globe 24 hours a day, 5 days a week. It never truly closes from Sunday evening New York time to Friday afternoon. Follows the sun. The trading day begins in Sydney, Australia, then moves to Tokyo, Japan. As Asia winds down, London and the European financial centers wake up. And finally, New York opens, overlapping with the European session for a few crucial hours before the cycle begins all over again. This creates a market that is always moving, always alive. For a trader, this is the definition of freedom and flexibility. Do you work a day job? You can trade the Asian session in the evening. Are you a night owl? The London session, often the most volatile and active, might be perfect for you. The market adapts to your schedule, not the other way around. This accessibility is a massive draw for people around the world who can't dedicate their prime working hours to a screen. However, this 24-hour nature is also a double-edged sword. It can be a siren's call to overtrade, to stay glued to your screen chasing every little move. With no forced downtime, the discipline to step away has to come entirely from you. The next massive difference is a concept that is both incredibly powerful and frequently misunderstood. Leverage. Leverage is essentially a tool that allows you to control a large position in the market with a relatively small amount of your own capital. Think of it like a down payment on a house. You might put down $50,000 to buy a $500,000 house. You are controlling an asset worth 10 times your initial investment. In trading, your broker provides this leverage. In the world of US stocks, leverage is quite restricted. For a standard margin account, you can typically get 2-to-1 leverage. This means if you have $10,000 in your account, you can buy up to $20,000 worth of stock. For qualified pattern day traders, this can go up to 4-to-1 on an intraday basis. So that same $10,000 could control up to $40,000 of stock, but only during the trading day. These limits are set by regulators to protect retail investors from taking on excessive risk. Now, step into the Forex market. The leverage available is on a completely different scale. In the United States, regulations cap leverage for major currency pairs at 50-to-1. Let's put that into perspective. With that same $10,000 account, you could potentially control a position worth $500,000. That's not a typo. $10,000 controlling $500,000. For every dollar in your account, you can command $50 in the market. The potential upside of this is obvious. If you're right about a currency's direction, even a small percentage move can result in a significant return on your initial capital. A tiny ripple in the market gets magnified into a wave in your account. This is what attracts many people to Forex. The potential for outsized outcomes from smaller capital investments is much higher than in stocks, purely based on the mechanics of leverage. But, and this is the most important, but you will ever hear about trading leverage is an amplifier. It doesn't know the difference between a gain and a loss. It amplifies everything. If the market moves against you by a small amount, that 50-to-1 magnifier is now working in reverse. It can wipe out your initial capital with terrifying speed. A position that would have resulted in a manageable loss in a stock account could lead to a total loss, a margin call, in a highly leveraged Forex account. It is a tool of immense power, and it demands immense respect and a deep understanding of risk management. Using high leverage without a solid plan is like handing a sports car to someone who has never driven before. The potential for a crash is incredibly high. Finally, we need to talk about the very structure of these markets where the trading actually happens. This might seem like a technical detail, but it affects everything from the price you get to the transparency of the market. The US stock market is a centralized market. When you want to buy shares of Apple, your order is routed to an exchange like the New York Stock Exchange or the Nasdaq. These are physical or electronic locations where buyers and sellers meet. It's like a giant, highly regulated auction house. Because everything flows through the central hub, there is a high degree of transparency. Everyone can see the official price, the volume of shares being traded, and the queue of buy and sell orders. This is known as price and volume transparency, and it's a cornerstone of the stock market structure. You are reasonably confident that the price you see is the true market price at that moment. Forex, on the other hand, is a decentralized market, also known as an over-the-counter or OTC market. There is no central Forex exchange. There is no single building in New York or London that houses the Forex market. Instead, it's a vast, global electronic network connecting major banks, financial institutions, corporations, and brokers. It's a web, not a pyramid. What does this mean for you? When you place a trade, you're not sending it to a central exchange. You're trading directly with your broker. Your broker, in turn, gets their pricing from their network of liquidity providers, which are usually large banks. Because of this, the price for a currency pair like the euro versus the US dollar might be slightly different from one broker to the next. The difference is usually tiny, but it exists. This structure is what allows Forex to be a 24-hour market. It's not dependent on one location being open, but it also means transparency works a bit differently. You can't see the total global volume for a currency pair because there's no central place to collect that data. Your view of the market is primarily through the lens of your broker. This is also where the concept of the spread becomes so important. In stocks, you might pay a commission. In Forex, the broker's primary fee is typically built into the price as the spread, the small difference between the buy price and the sell price. This makes the choice of a reputable, well-regulated broker absolutely critical in the world of Forex. So we have two completely different arenas for trading. One, a structured, transparent, time-bound market with conservative leverage. The other, a flexible 24-hour, decentralized market offering immense leverage. One is like a sanctioned, televised boxing match with clear rounds and a referee. The other is more like a global, continuous sparring session where you need to be much more aware of your opponent and your surroundings. The question of which one is better is the wrong question. The right question is which environment is better suited to your personality, your lifestyle, your capital, and your tolerance for risk. But we've only talked about the game board and the rules. We haven't even touched on the pieces themselves. What are you actually buying and selling? Is it better to analyze and invest in the story of a single company, its products, its leadership, its quarterly earnings, or to trade the macroeconomic story of an entire country, reflected in the value of its currency? The difference between trading Apple stock and trading the Japanese yen is as vast as the difference between the markets themselves. And that choice will fundamentally shape the kind of trader you become. So let's break down what that choice really means. Imagine two different kinds of detectives, both brilliant, but with entirely different jurisdictions. The first detective is a corporate investigator. Their world is the C-suite, the balance sheet, the factory floor. They live and breathe one company at a time. Before they make a move, they're poring over quarterly earnings reports, scrutinizing every line item. They're listening to earnings calls, analyzing the CEO's tone of voice for any hint of doubt. Is revenue growing? Are profit margins shrinking? What's the price-to-earnings ratio? And how does it compare to their direct competitors? They're obsessed with the details of a single entity. They want to know if a new product launch is a hit or a miss, if a supply chain disruption in one part of the world will cripple production, or if a key executive just left for a rival firm. This is the world of the stock trader. You are betting on the ingenuity, the management, and the market position of a specific company. Your success depends on your ability to become an expert on that business and its industry, to understand its story better than the rest of the market. Now, picture the second detective. This one isn't a corporate investigator. They're a global intelligence analyst. They don't have a single office building on their map. They have the entire globe. They aren't looking at one company's balance sheet. They're looking at a whole country's economic health. Their key documents aren't earnings reports. They're inflation reports, unemployment numbers, and gross domestic product figures. They aren't listening to a CEO. They are hanging on every single word from the chairman of the Federal Reserve or the president of the European Central Bank. A subtle shift in language about future interest rate policy can send shockwaves through their entire world. A trade dispute between two nations, a surprise election result, a change in oil production quotas. These are the clues they piece together. This is the world of the Forex trader. You aren't betting on a single company's product. You're betting on the relative strength of an entire economy against another. Your analysis is macroeconomic. You're trading the big picture, the grand currents of global capital flow. This fundamental difference in focus creates two completely different daily realities. The U.S. stock market, for the most part, operates on a schedule. The opening bell rings at 9:30 a.m. Eastern Time, the closing bell at 4 p.m. Yes, there's pre-market and after-hours trading, but the vast majority of volume and major moves happen within that defined window. This creates a structure, a rhythm. There's a beginning and an end to the trading day. You can, in theory, shut down your computer at 4 p.m. and disconnect, knowing the core game is paused until the next morning. It allows for a compartmentalized life. The battle has a defined arena and a defined time. The Forex market has no bell. It doesn't sleep. It's a relentless 24-hour day, 5-day-a-week beast that follows the sun around the globe. It opens in Sydney, then Tokyo takes over, then London comes online, and finally New York. For several hours, the London and New York sessions overlap, creating the most volatile and liquid period of the day. But the market is always open somewhere. This offers incredible flexibility. You can trade in the middle of the night if you want to, but it also presents a profound psychological challenge. There is no off switch. A major economic data release from Japan can rock the US dollar to Japanese yen pair, while you're fast asleep in Chicago. The fear of missing out, or FOMO, is a constant companion. It demands a different kind of discipline, the ability to define your own trading hours and stick to them, to accept that you cannot catch every move, because the market never stops moving. Your lifestyle must adapt to the market's rhythm, not the other way around. This difference in timing bleeds directly into the feel and pace of the markets. Think of stock trading like a series of distinct events. You have earnings season where for a few weeks, companies report their results, and their stocks can experience explosive, single-day moves of 10, 20, even 30% up or down. Outside of those events, a blue-chip stock might trend steadily for weeks or months, a slow and steady climb or decline. The volatility is often contained within the story of that specific company. Forex is different. It's less about a series of scheduled explosions and more about a constant flowing river of movement. The market is so immense, with trillions of dollars traded daily, that it moves in smaller increments called pips. Yet, this river can turn into a tidal wave in a nanosecond. When a central bank makes a surprise announcement, or a critical inflation number comes in far hotter than expected, the entire market can reprice in the blink of an eye. The volatility isn't tied to one company's success or failure. It's tied to the shifting confidence in an entire nation's economy. It's a game of relativity, constantly adjusting to new information from all corners of the globe, at all hours of the day. And this brings us to the single most important, and frankly the most dangerous difference between these two worlds for a retail trader: leverage. This concept is critical to understand because it's a tool of immense power. And like any power tool, it can build fortunes or it can cause catastrophic damage with terrifying speed. In simple terms, leverage allows you to control a large position with a much smaller amount of your own capital. It's like putting a down payment on a trade. In the world of US stocks, a typical retail margin account might offer you 2-to-1 leverage. This means if you have $10,000 in your account, you can control up to $20,000 worth of stock. There are strict regulations like the pattern day trader rule that govern how this margin can be used, designed to offer a layer of protection. Now, step into the Forex market. The leverage offered here is on an entirely different planet. It's not uncommon for brokers to offer 50-to-1 leverage to US clients. Let that sink in. With that same $10,000, you could potentially control a position worth $500,000. This is the siren song of Forex. It's what attracts so many people. The prospect of taking a small account and amplifying potential returns is incredibly seductive. But you must understand that leverage is a double-edged sword with no concept of mercy. It magnifies everything. If the market moves in your favor by just 1% with 50-to-1 leverage, your account could see a 50% gain. This is the scenario everyone dreams about. But if the market moves against you by that same 1%, your account could suffer a 50% loss. A move of just 2% against your position could wipe out your entire account. Gone. Leverage takes small, normal market fluctuations and turns them into make-or-break events for your capital. It compresses time and magnifies consequence. While the potential for accelerated gains is real, the potential for catastrophic lightning-fast losses is just as real, if not more so, for the inexperienced. So the choice isn't just about whether you want to analyze a company or an economy. It's about the very structure of your day, the psychological pressures you'll face, and the level of raw, unfiltered risk you are willing to engage with. One path offers a structured arena with limited, regulated tools of amplification. The other offers a boundless 24-hour ocean where you can be handed a financial engine of immense and unforgiving power. Understanding which environment fits your personality, your discipline, and your risk tolerance is the first, and most crucial, step in this entire journey. So let's talk about the throttle on that financial engine. It's a concept that sounds complex, But it's the single biggest mechanical difference between these two worlds. It's called leverage, and understanding it isn't just important. It's a matter of survival. Imagine you have a giant heavy boulder you need to move. You could try to push it with your bare hands using only your own strength. That's like trading with just your own cash. Or you could grab a long sturdy crowbar, stick it under the edge and use it to multiply your force. With a tiny push you can now move the massive rock. That crowbar, that is leverage. It's a tool for amplifying your power. In the world of US stocks, this tool is called trading on margin. It's regulated, it's controlled, and it's relatively conservative. For most retail traders, the standard leverage offered by a broker is 2 to 1. This means for every dollar of your own money you put up, your broker will lend you another dollar. So with $5,000 in your account, you can control $10,000 worth of stock. If you qualify as a pattern day trader, you might get access to 4 to 1 leverage, but only for trades you open and close on the same day. Think of this as a short, sturdy crowbar. It gives you an advantage, a bit of extra force, but it's not going to send the boulder flying into orbit. However, this tool still comes with serious risks. Let's say you use that 2 to 1 leverage. You have $5,000 and you buy $10,000 worth of XYZ Corporation. The stock goes up 10%. Your $10,000 position is now worth $11,000. You sell it, pay back the $5,000 you borrowed, and you're left with $6,000. You made a $1,000 profit on your $5,000 capital, a 20% return. Your leverage doubled your gains. But what if the stock goes down 10%? Your $10,000 position is now worth $9,000. You sell, pay back the $5,000, and you're left with just $4,000. You lost $1,000, a 20% loss on your capital. Your leverage also doubled your losses. If the stock were to drop, say 40%, your position would be worth $6,000. After paying back the broker, you'd only have $1,000 left. You lost 80% of your capital from a 40% drop. And if it drops further, you'll get the dreaded margin call, where your broker forces you to sell your position at a loss to ensure they get their loan back. It's a powerful tool, but in the stock market, the guardrails are high and the drops are, for the most part, manageable without instant catastrophe. Now let's walk across the street to the Forex market. Here they don't hand you a crowbar. They hand you a hydraulic industrial crane. In the United States, regulations limit leverage on major currency pairs to 50 to 1 for retail traders. In other parts of the world it can be 100 to 1, 500 to 1, or even higher. Let's stick with the US standard, 50 to 1. What does that mean? It means for every $1 of your own money, you can control $50 in the currency market. Suddenly, your $5,000 isn't controlling $10,000 worth of assets. It's controlling $250,000. Think about that for a second. $5,000 controlling $250,000. The sheer scale is difficult to comprehend. Why is this even possible? Because currency movements are, in percentage terms, minuscule. A stock might move 5% in a day. For a major currency pair like the euro versus the US dollar, a huge headline-making move might be just 1%. If you were trading without leverage, a 1% move on your $5,000 would net you a $50 profit. It's hardly worth the effort. Leverage is therefore not an option in Forex. It's a necessity. It's the only way to turn these tiny price fluctuations, these pips, into meaningful potential outcomes. But in doing so, it fundamentally rewires the entire concept of risk. Let's put two traders side by side. Trader A is in stocks, Trader B is in Forex. Both start with a $10,000 account. Trader A, our stock trader, decides to use standard 2 to 1 margin. He buys $20,000 worth of a popular tech stock. The stock has a great day and rallies 3%. His position gained 3% of $20,000, which is $600. A solid 6% return on his capital. He's happy. Now look at Trader B, our Forex trader. She uses the standard 50 to 1 leverage. With her $10,000, she takes a position controlling $500,000 of the British pound versus the US dollar. The currency pair moves in her favor by just 0.6%. A move that would be considered moderate, not even a huge news day. But 0.6% of her $500,000 position is $3,000. On her $10,000 account, she just made a 30% return. In a single afternoon. This is the siren song of Forex. This is the immense power, the incredible capital efficiency that draws people in. The potential to generate outsized returns from tiny market movements is intoxicating. But every siren song leads to rocks. Let's rewind the day. Let's say both traders were wrong. Trader A's tech stock falls 3%. He loses $600. It stings. It's a 6% loss on his account, but he lives to fight another day. His account balance is now $9,400. He can reassess, learn, and place another trade. Now Trader B. The currency pair moves against her by that same moderate 0.6%. She loses $3,000. A 30% loss. In a single afternoon, nearly a third of her capital has vanished. Her account is down to $7,000. The psychological blow is devastating. But what if the market moved a little more? What if there was a surprise economic announcement and the pair moved against her by 2%? A 2% move is not a black swan event. It's not a market crash. It happens. But a 2% loss on her $500,000 position is $10,000. Her entire account. Wiped out. Gone. From one trade on one moderate, not even historic market move. This is the brutal reality of high leverage. It doesn't just magnify your gains and losses. It compresses the timeline to zero. In the stock market, even with margin, you often have time. Time to be wrong, time for a position to recover, time to manage your risk. In the high leverage world of Forex, you have no such luxury. The line between a winning trade and a catastrophic account-ending loss is terrifyingly thin. It's not measured in percentage points. It's measured in fractions of a percent. This transforms the psychology of the game. It creates an environment where you feel you cannot afford to be wrong ever. A single mistake, a moment of indiscipline, an unexpected news event can be the end of your trading career. It fosters a short-term, all-or-nothing mindset that is the enemy of long-term success. It demands a level of emotional control, risk management, and precision that most people, frankly, do not possess when they are starting out. So when you ask which is better, you have to ask yourself about the nature of the power you want to wield. Do you want the sturdy crowbar of the stock market? A tool that can enhance your strength, but is unlikely to cause an instant disaster? A tool that allows for error and learning? Or do you seek the hydraulic crane of Forex, a machine with the potential for incredible feats of financial strength, but one that can collapse and crush you in the blink of an eye if you make a single operational error? This power, this leverage, is applied to markets that move for vastly different reasons. A stock price might surge because of a brilliant new product, while a currency can collapse because of a single sentence spoken by a central banker. Understanding these fundamental drivers is the next piece of the puzzle, and it's where the two worlds diverge even further. Let's start with stocks. When you buy a share of a US company, you're buying a tiny piece of a business. Its fortune, and therefore your investment's fortune, is tied to how well that business performs. The primary driver, the one that Wall Street obsesses over every 3 months, is earnings. Think of an earnings report as a company's quarterly report card. Did they make as much money as they expected? Did they beat expectations? Did they miss? A single number in that report, earnings per share, can send a stock soaring 20% or crashing 30% in a single day. It's the most direct measure of a company's health and profitability. But earnings are just the result. What creates those earnings? That's where the story gets interesting. It's about innovation. Did Apple just announce a new iPhone with features nobody has ever seen before? That's a fundamental driver. It's about management. Is the CEO a visionary like a Steve Jobs or a steady hand like a Tim Cook? The market hangs on their every word during investor calls, trying to read between the lines. It's about market share. Is Coca-Cola gaining ground on Pepsi in a key region? That's a fundamental driver. It's about moats, the competitive advantages that protect a company from rivals. Does Google have a near monopoly on search? Does Amazon have an untouchable logistics network? These are the stories that analysts and long-term investors dig into. They read financial statements, balance sheets, and cash flow statements, trying to understand the DNA of the business. Beyond the company itself, you have the industry sector. If a new technology like artificial intelligence suddenly explodes, companies like Nvidia, which make the essential hardware, see their fortunes rise on the tide of the entire industry. It doesn't matter if their individual report card is an A or an A+. They're in the right class at the right time. Conversely, if a whole sector falls out of favor, like brick-and-mortar retail in the age of e-commerce, even the best-run company in that space can struggle. And finally, you have the macroeconomic environment. This is the weather that all companies must operate in. If the Federal Reserve raises interest rates, it becomes more expensive for businesses to borrow money to expand. That can put a damper on growth and, by extension, stock prices. If inflation is running high, It eats into a company's profits and a consumer's spending power. These big-picture economic forces affect everyone, from the smallest startup to the biggest conglomerate. So, for a stock trader, the research path is clear. You start with the company, you look at its industry, and you keep an eye on the overall economy. It's a journey from the specific to the general. Now let's pivot to Forex, and this is where the landscape changes completely. When you trade a currency pair like the euro versus the US dollar, you are not analyzing a single company. There is no CEO. There is no new product launch. There are no quarterly earnings reports. Instead, you are fundamentally analyzing and comparing the entire economic health of two sovereign nations. The single most powerful driver in the Forex market is interest rates. Full stop. Capital, like water, flows downhill towards the path of least resistance and highest return. If the United States has an interest rate of 5% and Japan has an interest rate of 0%, large institutions, hedge funds, and banks will be incentivized to sell their Japanese yen and buy US dollars to earn that higher yield. This massive demand for the dollar drives its value up relative to the yen. This is why the central banker is the most important person in the Forex world. The chairman of the US Federal Reserve, the president of the European Central Bank, the governor of the Bank of England, these individuals are the CEOs of their currencies. When they speak, the entire world listens. A single phrase in a press conference, a subtle change in tone about future inflation, or a hint about raising or lowering interest rates can cause currency pairs to move hundreds of pips in a matter of seconds. Forex traders don't wait for quarterly reports. They set alarms for central bank meetings and speeches. Their world revolves around monetary policy. The second major driver is economic data. If a company has a report card, a country does too. These are the major economic releases you hear about on the news. Gross domestic product, or GDP, which measures the total economic output. The Consumer Price Index, or CPI, which measures inflation. Unemployment numbers. Retail sales. These data points paint a picture of the nation's economic health. A string of strong GDP and employment reports from the United States suggests the economy is robust, making the US dollar a more attractive currency to hold. A surprise jump in inflation in the Eurozone might force the European Central Bank to consider raising interest rates, which in turn could strengthen the euro. Forex traders live by the economic calendar, planning their entire week around these key data releases. And then there's a driver that has a much bigger and more immediate impact in Forex than in most individual stocks: geopolitics. Political stability is paramount. An unexpected election result, a referendum like Brexit, a trade war between two major powers, or in the most extreme cases, an actual war. These events can inject massive uncertainty and volatility into the currency markets. Money flees from uncertainty. If a country suddenly appears unstable, international investors will pull their capital out, selling that country's currency and causing its value to plummet. A stock investor might worry about how a trade war affects a specific company's supply chain. A Forex trader is concerned with how it affects the entire economic relationship and sentiment between the two countries involved. So let's crystallize the difference. Stock analysis is largely a micro-story. It's about the tangible success of a single entity, its products, its leadership, its profits. You're betting on the ingenuity and execution of a specific team of people. Forex analysis is a macro story. It's a relative game. The US dollar doesn't just get strong. It gets strong against the euro, or the yen, or the pound. You are always comparing two massive, complex economies and betting on which one will outperform the other based on high-level data and central bank policy. You could have two economies that are both struggling, and your job is to figure out which one is struggling less. A great company can thrive even in a weak economy. In Forex, the economy is the company. This fundamental difference in drivers dictates the kind of person who might be better suited for each. If you're fascinated by business, by innovation, by dissecting a company's balance sheet and understanding its competitive advantage, the world of stocks might feel like home. Your research involves reading industry publications, shareholder reports, and listening to CEO interviews. If, on the other hand, you're captivated by global politics, macroeconomics, and the cause and effect of government policy, Forex might be your arena. Your research involves watching central bank press conferences, studying economic calendars, and understanding the intricate dance of international relations. It's a top-down view of the world, not a bottom-up view of a company. One is a story of corporate success, the other a tale of national economies. But this difference in what drives them creates a dramatic difference in their personality, how they behave, how wildly they swing, and when they're even awake to trade. And that personality clash is what we're diving into next. Let's start with the most misunderstood concept of them all, volatility. When people hear Forex, they often picture wild, chaotic swings, numbers flashing red and green, a market on steroids. And when they think of stocks, especially big, boring blue-chip companies, they might imagine a slow, steady climb. The reality is almost the exact opposite, and understanding this inversion is the key to understanding the soul of each market. On a typical day, the exchange rate between the euro and the US dollar, the most traded currency pair on the planet, might move by 0.5%. A full 1% move is a huge, headline-grabbing event, usually triggered by a major central bank announcement or a shocking economic report. It's a massive deal. Now let's look at the stock market. The S&P 500 moving 1% in a day? That's just a Tuesday. It happens all the time. And an individual stock? A company like Tesla or Nvidia can jump or drop 5, 10, even 20% in a single day after an earnings report or a product announcement. On a pure percentage basis, individual stocks are vastly more volatile than major currency pairs. So why does Forex have this reputation for being a fast-paced, high-risk roller coaster? The answer lies in one single, powerful, and often dangerous word: leverage. Because currencies move in such small increments called pips, Forex brokers offer traders extremely high leverage to make those tiny movements meaningful. Leverage is essentially a loan from the broker that allows you to control a large position with a very small amount of your own capital. In the US stock market, a typical retail trader might get 2-to-1 or maybe 4-to-1 leverage. In Forex, it's not uncommon to see leverage of 50-to-1, and in some parts of the world even higher. Think of it like this. Trading an unleveraged stock is like trying to push a boulder by hand. You need a lot of force, a big price move, to see any significant result. Trading a highly leveraged Forex pair is like using a giant hydraulic lever. You apply a tiny amount of pressure, a small price move of a fraction of a percent, and the lever magnifies your force, sending the boulder flying. But here's the critical part that many people forget. That lever works with the exact same force in the opposite direction. A tiny move against you can send that same boulder crashing right back down on your account. This is the Forex paradox. The underlying asset is low volatility, but the common method of trading it creates extremely high volatility outcomes. That 0.5% move in the euro to US dollar, which seems so small when magnified by 50-to-1 leverage, becomes a 25% gain or loss on your capital for that trade. Suddenly, that stable currency market feels a lot more like a casino than the stock market. This is the single biggest reason why many new traders are drawn to Forex, by the potential for large returns from small price moves, and also why many face significant losses. It's a powerful tool, a true double-edged sword that magnifies every outcome. This fundamental difference in personality extends to when these markets are even awake. The US stock market has a very clear rhythm. It has a schedule. The opening bell rings at 9:30 a.m. Eastern Time, and the closing bell rings at 4 p.m. Sure, there's some pre-market and after-hours action, but the main event, where the vast majority of volume and drama happens, is confined to that 6.5-hour window. It's a daily sprint. Traders gear up, the race begins, they react to the day's news, they manage their positions, and then it's over. The market closes. You're forced to take a break, to step back, to analyze, to plan for the next day. This structure can be a huge psychological benefit. It imposes discipline. Forex is the polar opposite. It is a relentless 24-hour-a-day, 5-day-a-week marathon. Because it's a global market, it literally follows the sun around the planet. The trading day begins in Sydney and Tokyo, then moves to London, the heart of the Forex world, and then passes to New York, before starting all over again in Asia. There is no opening or closing bell. It's a continuous, flowing river of capital. For some, this is the ultimate freedom. You have a day job? You can trade the London session in the early US morning, or the Asian session late at night. You're a night owl? The market is always there for you. But this freedom comes with its own set of challenges. The temptation to overtrade is constant. The fear of missing out, or FOMO, can be intense, because there's always a move happening somewhere in the world. There's no forced downtime. This can lead to fatigue, emotional decision-making, and burnout. Are you the kind of person who thrives on a structured, intense sprint, or one who prefers the flexibility and endurance test of a perpetual marathon? Your answer to that question says a lot about which market's personality might be a better fit for yours. Finally, let's talk about the sheer scale of the playground. Imagine the Forex market as a single vast, deep ocean. It is the largest, most liquid financial market on Earth, with trillions of dollars changing hands every single day. For a retail trader, this means that for major currency pairs like the euro, the yen, or the British pound, you can almost always get in and out of a trade instantly at a fair price. The gap between the buying price and the selling price, known as the spread, is typically razor thin. The ocean is so vast that one individual trader's actions are like a single drop of water. They have no impact. Now picture the stock market. It's not one ocean. It's a massive continent with thousands of different bodies of water. You have enormous lakes like Apple and Microsoft, which are incredibly deep and liquid, much like the Forex market. But you also have countless smaller rivers, streams, and even tiny ponds. These are the small cap and mid cap stocks. While trading a stock like Apple is seamless, trying to buy or sell a large number of shares in a small, obscure company can be difficult. There might not be enough buyers or sellers at the price you want. The spread can be wide, meaning you lose a chunk of money just by entering and exiting the trade. Your own order can even move the price, a phenomenon known as slippage. This means that in Forex, your focus is narrowed onto a handful of major oceans, the major currency pairs. In stocks, you have a universe of over 6,000 choices in the US alone, ranging from the most liquid assets on Earth to highly illiquid and speculative penny stocks. Do you prefer the focused simplicity of monitoring a few massive, interconnected markets, or the thrill of discovery and the potential for explosive growth by finding a hidden gem in a vast universe of individual companies? So we have one market that's a 24-hour marathon of leveraged micro-movements, driven by the subtle tectonic shifts of entire nations. And we have another that's a daytime sprint of dramatic corporate stories, with thousands of individual characters, each with its own unique volatility and plot twists. This fundamental difference in their nature, their volatility, their schedule, their very structure, leads to a profound difference in how traders try to predict their next move. Do you listen to the whispers of global economics, or the shouts of a CEO on an earnings call? That's the strategic divide we'll cross next. When you analyze a stock, you become a business detective. You're poring over a single company's story, trying to determine its intrinsic value. The most revered tool for this is fundamental analysis. Think of it like this. You're not just looking at the price tag of a car. You're popping the hood, checking the engine, reviewing the maintenance records, and researching the manufacturer's reputation. For a stock, this means digging into financial statements. You're looking at revenue growth. Is the company selling more this year than last? You're examining profit margins. Are they keeping a healthy slice of that revenue? Or are costs eating everything up? You're scrutinizing the balance sheet for debt. Is this a lean, efficient company? Or is it drowning in liabilities? The language of stock fundamentals is one of PE ratios, or price to earnings. This metric tells you how much investors are willing to pay for every dollar of the company's profit. A high PE might suggest investors are optimistic about future growth, while a low PE could signal a potential bargain, or a company in trouble. You're also listening to the narrative. The quarterly earnings call becomes a major event. It's where the CEO and CFO face Wall Street, explaining their successes and failures. A single sentence, a slight hesitation in the CEO's voice, can send a stock soaring or tumbling. You're assessing management quality, competitive advantages, what investors like Warren Buffett call a moat, and the overall health of the industry it operates in. Is it a buggy whip manufacturer in the age of the automobile? Or is it building the next generation of artificial intelligence? The focus is intensely microscopic. You could become the world's leading expert on a single company, like Apple or Tesla, and build an entire trading strategy around that deep specific knowledge. Now let's pivot to Forex. If stock analysis is a microscope, Forex fundamental analysis is a telescope. You're not looking at a single company, you're looking at the entire economic health of a nation, and then comparing it to another. The questions you ask are vast and sweeping. The single most powerful driver in the Forex market is interest rates. Central banks like the US Federal Reserve or the European Central Bank are the main characters in this story. When a central bank raises interest rates, it typically makes holding that country's currency more attractive to foreign investors because they can earn a higher return. This increased demand can strengthen the currency. So a Forex trader hangs on every word from a central bank governor. Their speeches, their meeting minutes, their inflation forecasts. These are the equivalent of a company's earnings report. But it doesn't stop there. You're also looking at economic data releases that act as a nation's vital signs. The Consumer Price Index, or CPI, measures inflation. High inflation can pressure a central bank to raise rates. Gross Domestic Product, or GDP, measures the total economic output. Strong GDP growth signals a healthy, expanding economy, which is good for its currency. You're watching employment numbers. A country with low unemployment and rising wages is typically a sign of economic strength. You're even looking at political stability and trade balances. It's a macroeconomic puzzle. You're not trying to figure out if one company will sell more iPhones next quarter. You're trying to determine if the United States economic outlook, as a whole, is stronger than Japan's, suggesting the US dollar might rise against the Japanese yen. It's a grand-scale comparison of national report cards, so the strategic divide is clear. The stock analyst masters the art of the specific. The Forex analyst masters the art of the broad. One reads balance sheets, the other reads economic calendars. One worries about a competitor launching a new product, the other worries about a shift in global trade policy. But what if you don't care about the why? What if you believe all that information, every earnings report, every interest rate decision, every news headline, is already baked into the price you see on the screen? This is where the second major school of thought comes in, a philosophy that unites both worlds. Technical analysis. Technical analysis is the universal language of charts. It's the belief that price action tells you everything you need to know. A technical analyst is like a seasoned sailor reading the waves and the clouds. They don't need to understand the complex meteorology of global weather systems to know a storm is coming. They see the pattern and they react. In both stocks and Forex, this means looking at price charts and using various tools to identify trends, patterns, and potential turning points. You'll hear terms like support and resistance, which are price levels where a stock or currency pair has historically struggled to break above or below. You'll see moving averages, which smooth out price data to help identify the underlying trend direction. You'll use indicators like the Relative Strength Index, or RSI, to gauge whether an asset is overbought or oversold. For a stock trader, technical analysis can be a primary strategy or a secondary tool. A day trader might ignore a company's fundamentals entirely, focusing solely on short-term chart patterns to make dozens of trades a day. A long-term investor, on the other hand, might first use fundamental analysis to identify a great company, and then use technical analysis to pinpoint a better entry point, perhaps waiting for the stock to pull back to a key support level before buying. However, a stock's technical pattern can be fragile. A surprise product recall, a sudden CEO resignation, or a disastrous earnings report can create a massive price gap overnight, completely obliterating any neat trend line you had drawn on your chart. Company-specific news is a constant, disruptive force. In the Forex market, many would argue that technical analysis plays an even more central role, especially for retail traders. Why? Because of the market's sheer scale and liquidity. With trillions of dollars changing hands daily, the price action of major currency pairs tends to be smoother. It's much harder for a single entity or a single piece of news, short of a major central bank announcement, to violently disrupt the market's flow. The price of the euro to US dollar, for example, is the aggregate opinion of millions of participants worldwide, from a bank in Tokyo to a hedge fund in New York to a retail trader in London. This wisdom of the crowd often carves out cleaner, more reliable trends and patterns on the charts. The movements are less about the idiosyncratic drama of one company and more about the slow, powerful currents of global capital. Technical analysts thrive in this environment, seeing it as a pure reflection of market psychology and supply and demand. So which path resonates more? Are you the micro-detective piecing together clues from a company's financial reports to uncover a hidden gem? Or are you the macro-strategist, connecting the dots between inflation data, interest rate policy, and geopolitical events to forecast the shifting tides of global economies? Do you want to master the story of a single corporation or the relationship between two nations? Or perhaps do you want to ignore the stories altogether and learn the universal language of the charts, reading the patterns that human psychology leaves behind in the form of price? The stock trader often invests in a narrative of innovation, growth, and corporate leadership. The Forex trader trades the differential, the gap between one country's economic strength and another's weakness. One is a vote of confidence in a specific enterprise. The other is a relative judgment on the state of a nation. So we have the micro-detective versus the macro-strategist, the company analyst versus the global economist. But beyond the charts and the reports, there's one final crucial element. You. Your personality, your tolerance for risk, and the very way your brain is wired for decision-making. Which arena is your mind built for? That's the final piece of the puzzle. Let's unpack that. Think of two personality profiles. On one side, you have the high-frequency thinker, the individual who thrives on adrenaline, who can process multiple streams of information at once, and who can make split-second decisions under immense pressure. This person is a pattern seeker, a strategist who sees the world as a giant interconnected chessboard. They're fascinated by geopolitics, by the whispers of a central bank governor, by the ripple effect of an inflation report from halfway across the world. They understand that in the world they operate in, hesitation can be more costly than a wrong move. They are comfortable with the idea of leverage, not as a shortcut to riches, but as a tool that amplifies both their analysis and their risk. They are disciplined, almost ruthlessly so, because they know that emotion is the enemy of a sound strategy. They can take a loss, analyze what went wrong without ego, and be ready for the next opportunity in minutes. This is the mindset that often gravitates towards the Forex market. It's a sprinter's game. It's about being right now and moving on. The reward isn't just the potential profit. It's the intellectual victory of correctly predicting the next move in a global economic dance. Now, on the other side, you have the value builder, the individual who derives satisfaction from watching something grow over time. They are patient, methodical, and more interested in the why than the when. They don't just see a stock ticker. They see a company. They see employees, products, a brand, and a long-term vision. They enjoy the process of discovery, of reading an annual report and finding a hidden gem, of understanding a company's competitive advantage so deeply that a 10% drop in the stock price looks less like a crisis and more like a sale. Their tolerance for risk is different. They are not averse to it, but they want it to be calculated over years, not minutes. They are investing in a story, in the potential of human ingenuity and corporate strategy to create tangible value over a decade. They don't need the constant stimulation of a 24-hour market. In fact, they prefer the opposite. They want the market to close so they can have time to think, to research, to disconnect from the noise and focus on the signal. This is the classic stock investor's mindset. It's a marathon. It's about planting a seed and nurturing the tree, understanding that there will be storms and droughts, but having faith in the fundamental strength of what you've chosen to cultivate. So ask yourself which one sounds more like you. When you face a complex problem, do you attack it with a flurry of rapid, tactical decisions, or do you step back, gather extensive information, and formulate a single long-term strategic plan? When you play a game, do you prefer the fast-paced intensity of chess, or the slow, deliberate empire building of a game like Civilization? There is no right or wrong answer. A world-class sprinter and a world-class marathon runner are both elite athletes, but you would never ask one to compete in the other's event. The skills, the training, and most importantly, the mindset are fundamentally different. Trying to force a marathon runner's patience onto the 5-minute Forex chart can lead to missed opportunities and paralysis. Trying to apply a Forex sprinter's need for speed to long-term stock investing can lead to churning your account, selling winners too early, and buying into hype at the top. But here's the secret the pros know. It's rarely a strict either/or choice. The most sophisticated financial minds on the planet don't just pick one. They understand that Forex and stocks are simply two different tools in a much larger toolbox, each designed for a specific job. Think of it like a carpenter. A hammer is not better than a saw. They perform entirely different functions. You can't build a house with just a hammer. You can't build one with just a saw either. Many experienced individuals use the stock market as the foundation of their financial house. This is where they build long-term generational wealth. They invest in broad market ETFs, in blue-chip companies, in sectors they believe will define the next decade. This is their marathon. This is the core. But maybe they also have a deep understanding of monetary policy. They see a clear divergence between the Bank of England's path and the US Federal Reserve's. So they might allocate a small, strictly defined portion of their capital they are fully prepared to lose, to a speculative trade on the pound versus the dollar. That's their sprint. It's a tactical play, separate from their core strategy. It doesn't replace their stock portfolio. It complements it. This hybrid approach allows them to capture opportunities across different time horizons and asset classes. But it requires a level of discipline and knowledge that takes years to build. It requires the ability to switch mindsets, to be a patient farmer with one part of your capital and a nimble hunter with another. So, as we bring this entire journey to a close, let's reframe the original question. It was never truly Forex versus stocks. That's the wrong way to look at it. The real question is, what are you trying to build and what kind of builder are you? Are you trying to build a solid brick-and-mortar skyscraper that will stand for 100 years? That requires a foundation, patience, and a belief in long-term growth. That sounds a lot like investing in the great companies of the US stock market. Or are you trying to be a master tactician, capitalizing on short-term inefficiencies and movements in the world's largest and most liquid market? That requires speed, agility, and a deep understanding of macroeconomic forces. That is the world of Forex. The choice isn't about which market offers more potential. Both have seen people build incredible wealth and both have seen people lose everything. The choice is about which market's rhythm matches your own internal rhythm. Which market's risks are you better equipped by personality and by knowledge to manage? The stock market's primary risk is often systemic and long-term. A recession, a shift in technology. The Forex market's primary risk is often event-driven and immediate. A surprise interest rate hike, a political crisis. Which of those can you stomach? Which of those can you plan for? Your final takeaway should be this. Before you ever open a brokerage account, before you look at a single chart, open a mirror. Spend time understanding your own financial goals, your time horizon, your emotional triggers, and your genuine tolerance for risk. Be brutally honest with yourself. There is no glory in being a Forex trader if the stress keeps you up at night. There is no wisdom in being a stock investor if you lack the patience to hold through a downturn. The best market for you is the one that you can participate in with a clear head, a steady hand, and a plan that you can stick to in good times and in bad. The most critical investment you will ever make is not in a currency pair or a stock certificate. It's in your own education and your own self-awareness. Start there. That is the only path that leads to a sustainable financial future. The journey of 1,000 miles begins with a single step, and in the world of finance, that first step is always to know thyself.